With exactly $87.03 billion in record net sales, the Procter Gamble company is somehow selling zero additional products. But does this volume stagnation mean Wall Street's favorite consumer giant hit a pricing wall, or is a hidden cash flow fortress quietly protecting its fundamental value? When you see fiscal year 2026 net sales reaching exactly $87.03 billion, the initial instinct is to celebrate. Headlines scream about a solid 3% year-over-year revenue growth, assuming the business is flawlessly executing its strategy. But when you dig into the consumer data, global volume growth sits at exactly 0%. The Procter Gamble company drove that top-line expansion through favorable foreign exchange and price hikes, while the physical volume of goods sold, like Tide Pods, remained completely flat. And this is something you can easily check for yourself in the quarterly breakdown. This dynamic is obvious in the fourth quarter, where the grooming segment volume declined by 1%. Meanwhile, the high-margin healthcare segment volume dropped by 3%. Consumers are actively pushing back against higher price tags, forcing the firm to rethink its blueprint for future expansion. This reveals the core mechanism. Historical reliance on price hikes to drive revenue has reached a practical ceiling. But to grasp why this pricing wall is dangerous, we must look at the underlying cost structure. Even with top-line revenue growth safely secured, the gross margin contracted by 100 basis points to land at 50.2%. Notice how most observers are captivated by those record sales, but they completely ignore how structural operational costs silently erode core profitability. The business faces higher commodity costs and an unfavorable product mix, alongside a 6% spike in selling, general, and administrative expenses. Consequently, the operating margin dropped a severe 160 basis points year-over-year to 22.7%, meaning the firm keeps less profit for every dollar earned. The fundamental reality is that the current cost-cutting measures are being temporarily outpaced by these persistent structural costs. To put that margin squeeze in perspective, fourth quarter net earnings fell sharply by 15% to $3.08 billion. Correspondingly, fourth quarter earnings per share dropped a troubling 15% to $1.26. The Procter Gamble company is fighting a high-stakes battle between rising raw material costs and its internal efficiency programs. Management has warned of a massive $1 billion after tax cost headwind expected next year. This squeeze shows that price bumps for premium razors can no longer absorb rising transportation and material costs. This brings us to the real elephant in the room: how a legacy company under such heavy margin pressure maintains its elite market valuation. The undeniable answer lies in the operating cash flow, which was highly robust at $19.56 billion for the fiscal year. Most analysts are purely focused on those contracting margins, missing the vital fact that the company operates as an incredibly efficient cash-generating engine. The business achieved an adjusted free cash flow productivity rate of 100%. Once you grasp this cash conversion power, you will look at financial reports in a new light. This exceptional liquidity profile allows management to confidently deploy a massive $15.26 billion capital return program. Specifically, the firm distributed $10.23 billion in dividend payments to its investors. Concurrently, they executed an additional $5.03 billion in treasury stock purchases to reduce the share count. For investors, this creates an impenetrable floor for the stock, providing a highly reliable yield despite stagnant top-line volumes. The company marked 70 consecutive years of dividend increases, establishing a financial shock absorber against broader market volatility. While the crowd obsesses over flat consumer volume, the true valuation driver is converting physical goods into predictable liquid capital. But pure cash generation alone cannot fund infinite growth if the core operations of the business begin to permanently stall. Looking ahead, management issued a highly cautious forecast, projecting organic sales growth of just 1 to 3% for the upcoming fiscal year. At first glance, short-term traders might view this as a highly disappointing slowdown. However, the firm deliberately manages expectations by forecasting core earnings per share growth to range from a flat 0% to a maximum of 3%. By baking in that forecasted $1 billion drag from energy and transportation, the business prepares for complex economic crosswinds. Inflation remains incredibly stubborn, with the consumer price index sitting at 3.4%. Furthermore, the federal funds rate target range remains elevated at 3.5 to 3.75%. The Procter Gamble company must rely on a resilient domestic consumer base, supported by United States retail sales growth of 5% to offset international currency fluctuations. This conservative outlook shifts the focus squarely onto executing their ongoing $1.6 billion restructuring plan to streamline global operations. To properly execute this defensive maneuver, the firm is simultaneously shifting its offensive strategy. This brings us to the strategic acquisition of the premium wellness brand Thorne, designed to capture high-margin revenue in the rapidly expanding health sector. While legacy consumer staples like dish soap provide steady cash, the business acknowledges that future margin expansion must come from higher growth categories. The firm is actively transitioning from a defensive pricing posture to an offensive portfolio optimization strategy. Simultaneously, the recent consolidation of leadership, where the chief executive officer assumed the additional role of chairman, signals a clear mandate for unified execution. The Procter Gamble company is organizing its top governance to allow for highly aggressive portfolio rationalization. Overcoming that 0% global volume growth requires agile decision-making, not just endless price increases. The company is successfully positioning itself to extract premium yield while ruthlessly optimizing traditional production lines. Let us circle back to the opening dilemma. A consumer giant generating record revenue without selling a single extra product. The fundamental truth is that the Procter & Gamble company has indeed reached the practical limits of its pricing power. Margins are undeniably compressing, and the global consumer is finally pushing back against higher costs at the checkout counter. However, the firm is deploying its cash flow mechanism to fund internal restructuring, maintaining one of the most reliable dividend records in market history. This is a critical transitional period for the firm. They are deliberately pivoting from simple price hikes, focusing instead on deep operational efficiencies and premium acquisitions like Thorne. While upcoming cost headwinds will pressure short-term earnings, the sheer scale of those $87.03 billion in sales protects its foundational value. For the pragmatic investor, the current valuation presents a classic test of market patience. The Procter & Gamble company is not a volatile momentum play. It is a defensive compounding machine navigating a highly complex macroeconomic landscape. As long as free cash flow productivity remains pristine, this stock offers a durable margin of safety for your portfolio. Keep a close eye on volume metrics next quarter because underlying consumer demand ultimately matters. But I want to hear your take. Will consumers eventually accept these higher prices for premium everyday essentials, or are we witnessing a permanent shift toward much cheaper store brands across the globe? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.